Hey guys, if you stumbled across this video and you're wondering about temporary rate buy downs, they are back for 2025. I'm going to tell you why they're back, what's going on in the market as a mortgage broker who works in the market all day, every day. I talk to consumers all day, every day. Talk to real estate agents all day, every day. So I can tell you with absolute certainty that buy downs have made a comeback in 2025. If you're looking to get into a home, you're looking to reduce your monthly payment over the first couple of years until opportunity presents itself to refinance, watch this video. I'll explain to you how the rate buy downs work, how to negotiate them, how much credit you're going to give. I'm going to give you a specific example of how powerful this product is. Again, like most mortgage products, it's not for everybody, but I think it might be able to help you. So let's jump right in. Before I show you the example, why are temporary rate buy downs back? A number of reasons. Mortgage rates being elevated for quite some time now makes it to where there's not a lot of demand in the market. And even though a lot of places across the country have limited inventory, when there's not a lot of demand, when rates are 7% and there's not as many buyers that can qualify, home prices continue to go up. It's going to make for, quite honestly, more of a buyer's market. And buyer's market means you as the buyer have more leverage. What you do with leverage is you tell the seller, you've been on the market for 60 days. I'm not going to pay you $500,000 for this house. I'll pay you $485,000. Or better yet, I will pay you the $500,000 asking price, and I'd like $15,000 in seller credit. I'll show you that example, how that $15,000 in seller credit can be used to save you hundreds of dollars per month, right? A $15,000 discount on a house in general is going to save you about $100 a month. In my example, I'm going to save you more than $600 a month for the first 12 months of the mortgage. And I'm going to explain to you why I think that's probably a better play for a lot of people. Again, I've said this across hundreds of videos. Mortgage scenarios are specific to the person. What works for you might not work for your cousin. What works for your cousin might not work for your aunt. But knowing that this stuff's available, knowing how to negotiate it will be key. So as we end 2024 with higher interest rates, as we go into 2025 with what a lot of people thinks is going to be a higher interest rate environment, you're going to have the opportunity to negotiate. And quite honestly, this is why new builds make up 30% of home sales in 2024. And they'll make up 30% plus in a lot of markets in 2025 and beyond, because new builders understand monthly payment is the number one factor for buyers. And if you're a buyer, tell me down in the comments if you agree or disagree, right? Is there anything you care more about than monthly payment, right? If you pay $488 or $512 or, $504, $500, does that matter the most? Is that number the most important number? Or are you telling me, listen, I really need to get my payment under $3,500 a month? That's the type of stuff that I hear from buyers I talk to. So let me know if you agree or disagree. And without further ado, let's put up a scenario where you find a house that fits all your wants and your needs. And again, use the 80-10-10 rule. 80% is the house you're looking for. 10% you can learn to live with, and 10% you can remodel to your liking. So it's not always going to find the perfect house, especially if you're a first-time home buyer. Set realistic expectations. But you find the house, it's listed for $500,000. You talk to your agent, who's a great agent because you talked to him at the mortgage guy and he referred you to the great agent. They say, listen, this house has been on the market for 44 days. You don't have to pay $500 for it. We can go in and negotiate a discount. This is, something that's well worth the $500, but let's try to get it for $485, $490. Here's what you should think about doing. Instead of just offering $485,000, offer the $500,000 that the seller wants and ask for $15,000 in seller credit. To them, they're going to net $485, but something psychologically tells them that they've got their 500 number. So trust me on this. Been a part of a couple thousand transactions. $500,000 with $15,000 in seller credit, for whatever reason, sounds better to the seller than an offer of $485,000. Although the exact same number will go into their bank account at the end of the transaction, 500 with $15,000 in seller credit sounds and feels to them like we got our number. So you take that $15,000 in credit, 10,981 of it is going to be used for a 2-1 temporary buy down. I've gone over this in previous videos. So if you want a breakdown of exactly what a 2-1 buy down is, I go into detail, but it's pretty simple. A 2% discount on the rate in year one, which lowers your payment, as you would imagine, a 1% discount in year two, and then years 3 through 30. It's just like a 30-year fixed rate mortgage at 6.5%. So those that say this is variable, those that say this is anything but a discount in your first couple years are either confused or wrong. One of the two. You get a discount that's subsidized by the seller. For a lot of buyers, it works out great. I know there's going to be people in the comments that say, well, you can just take the $10,981 and pay yourself X number of dollars per month towards your payment, and then it does the same thing. Well, welcome to America, where most people aren't going to do that, right? As much as I would love to say that everybody's got tons of financial discipline, there's a reason why Dave Ramsey sells tens of millions of products every single year, because people just ain't got the discipline. So this puts the discipline in place for you. And here's the example. You buy it for $500 with 3.5% down FHA. You got a 6.5% interest rate, principal, interest, taxes, insurance, mortgage insurance. The whole kit and caboodle is $39.53 a month. Feels like a stretch, and it is for a lot of people. I get it. The 2-1 buy down allows you to have a payment in year one of $33.38. Let me make these numbers bigger. So if you're anything like me, getting older every day, $33.38, roughly $615 a month, probably exactly $615 a month cheaper than that payment that you'll have starting in month number 36. But you close on this loan in January of 2025. Your first payment is due March of 2025. March of 25, $33.38 is due, all the way until March of 2026, when you start paying $36.38 a month. There's no guarantees, but what happens in a lot of these cases is you're subsidizing the payment for a year or two, thinking that it would be pretty neat if interest rates came down and you were able to refinance before March of 2027, when the payment goes to $39.53. If you do, by the way, a cool function of buy downs is that you will recoup any unused buy down funds. $10,981 is sitting in this escrow account. It's subsidizing your payment by $615 a month for the whole year one. And then year two, some quick math there, it looks like $315 a month. If you've got 6 months left of $315 a month that you haven't used, that $1,890 gets applied directly to your principal. The $1,890 doesn't go out the window. You get it as a principal reduction. Cool, right? So the seller credit doesn't, get washed. And in this case, the scenario I set up was you ask for $15,000 in credit, you get it. $10,981 goes towards the buy down. The other $4,019 offsets some of your closing costs. So if my estimate was 2% of the sales price, $10,000 in prepaid taxes and insurance and title fees and lender fees and all the stuff, $4,000 of that is paid. So you're putting 3.5% down plus the closing costs that you have to pay for. After that $4,000 discount is applied, you're out of pocket about 25 grand. And so this is just a real life scenario. I like to do this. I think it helps people understand it better. Here's something to consider. 500,000, 6.5%. About the rate you can get without cost for a middle of the road credit score. 39.53. Remember that number. Let's go down to 485. 38.39. 3834, I'm sorry. So you got $15,000 off of the price down to 3834. You saved $119 a month by getting $15,000 off the price. Would you rather save $119 a month or structure it this way where you save $600 in year one, $300 in year two, roughly? For an overwhelming amount of people, when I show them both options, they go with this option. It's called a temporary buy down. You're going to run into scenarios in Q4 of 24 and Q1 of 25, and who knows how far beyond. It kind of depends on how long rates stay elevated, where this $15,000 in seller credit is not that hard to negotiate if you've got a great buyer's agent. So go out there, negotiate yourself a great deal. Make sure you're working with an agent and a lender who have your back, who know how all of this works, and are able to negotiate on your behalf the price, the credit, and then structure a great mortgage that makes sense for you. Mortgage scenarios are very unique and individualized, so what works for somebody else might not work for you. If you want to get started, get yourself pre-approved, see what you qualify for, and run some numbers like this, go to greatmortgagebroker.com. Me and my team are licensed in 48 states. We're more than happy to help. If you're 3 months out, 6 months out, a year out, no problem. We're still happy to help answer any questions you got. Greatmortgagebroker.com. Talk to you soon. Bye-bye.